thank you everyone for joining us today, and welcome to our discussion on breaking ground in the European private credit CLO market. Before we get down to it, we'll start off with some introductions. My name is Paddy Rath, and I'm a partner in the Finance and Capital Markets team at Walkers in Dublin. Walkers had the pleasure of acting as Irish legal and tax advisors to Barings in connection with their first European private credit CLO, and we also acted as Irish listing agent and corporate services provider on the deal.
Good afternoon, everyone. My name is Ali Mukhtar. I am the head of structuring CLOs at BNP Paribas.
Hi everyone, and thanks for having us today. My name is Ollie Hawks-Smith. I work at the European High Yield team at Barings, where I'm responsible for our European CLO issuance.
Good afternoon, Ben Love. I'm a managing director at Churchill Asset Management. I'm the head of fund finance, so I oversee all liability management for the firm and our funds. I also oversee our structured capital efforts, where we manage 10 private credit CLOs currently, 3 CFOs, and a number of rated feeders. But excited to be here and looking forward to an interesting panel.
Matthias Neugebauer. I manage the ratings team at Fitch that rates European CLOs.
Okay, great. So the potential for a private credit CLO in Europe has been a mainstay discussion point at most European CLO industry conferences for the last 3 or 4 years. I can't overstate how excited I was when we received an instruction from Barings to incorporate Barings Euro Middle Market CLO 2024 1 DAC. A number of commentators at kind of CLO industry conferences had pointed to a number of hurdles that would need to be overcome in order to get a European private credit CLO away. And those hurdles included issues around diversity, issues around ratings, issues around multi-currencies, and just the market size and obligor size in general. And so today we're going to hear how BNP Paribas, Barings and the other stakeholders in the Barings and Middle Market transaction overcame those hurdles to get the first European private credit CLO away earlier this year, or last year, sorry to say. So Matthias, we might start with you if that's okay. So ratings has for a long time been identified as one of the kind of significant potential issues around getting a private credit CLO away. So how did you guys approach ratings on the Barings Middle Market CLO deal?
Pretty much the same as we do the middle market CLOs in the US. So we did credit opinions for the entire portfolio, and I guess kind of the data situation was very good. I mean, there wasn't that much of a hiccup on that side. Barings was able to provide the management reports on the individual credits, and also data in a good format that our corporate team could process very quickly. So I think the turnaround time was something of 4 to 6 weeks once we got all the data to turn this into credit opinions, and then we did the analysis on the structure.
Okay, and Ollie, from your perspective, how did you manage the ratings process?
Yeah, I mean it's an interesting process. I think taking a step back in terms of getting the assets that you need to go into the vehicle, then you've got to get them rated. You obviously need to have a wide selection of assets that are going to meet the relevant credit criteria to get the relevant ratings to make the CLO work. And I think Barings being in a unique position that we've been very active in the private finance market for many years, very differentiated and multiple areas of liquidity for that financing, including balance sheet investments. So we were able to sort of select through assets that we owned on balance sheet, and have a view that we felt that we knew what the ratings would likely be on these assets, and I think that's very much down to our ongoing investment processes, the fact that we've invested for years for our parent and insurance company's balance sheet, very much have that sort of investment ethos within the team. So understanding that we would have the right type of assets that we felt that would be rateable and get the right ratings, I think is the most important thing, was important. And ultimately, as you get individual names rated and individual assets rated, there is a cost element to that. And really how we processed it was we sent over an initial handful of names that we felt would show a good spread across the assets from some of the higher risk names to some of the lower risk names that we felt would ultimately go in the portfolio. We had those rated. Those ratings came back from Fitch and S&P, who were also on the transaction, and that really affirmed that our thinking, our expectations on the ratings of the names we're putting across was pretty much in line with what was coming out with Fitch and S&P, and then we could sort of start to layer in more names, because ultimately there's a cost to that, and if you went and rated all your names, there's 46 different names in this individual CLO, if you went and did all those and you found out they weren't sufficiently rated, or the ratings came back lower than you needed for the CLO, it's a large cost item that you can go through. So it was a measured approach, but I think also reflects the ongoing investment processes and ethos in the private finance and investing team that meant that they was very well matched for a CLO.
Okay, so kind of tiered approach then, effectively.
Yep.
Yeah. Aleem, can you touch on some of the structural features of the transaction generally? I mean, I know it was a static deal, but one of the hurdles that had been kind of flagged by commentators in the past was kind of diversity issues. Can you kind of just touch on some of those points and kind of maybe outline how you overcame some of those issues?
Yeah, sure. So I think, again, this has been a long time in the making. I've attended conferences over the past 3-4 years where the question has always been, when's the next one coming? And the answer to that was never clear, because obviously there's challenges in Europe around asset sourcing and granularity. So I think when we started working with Barings on this one together, I think we had to basically look at the whole process, right from who's going to buy this, from the investor base, and then what do the assets look like. And then we had to obviously connect all the dots to make sure there's a product which is viable for Barings and also which is sellable to investors. So there was a lot of iterations with the guys at Barings in terms of what the portfolio should look like. The biggest challenge, and again, this is well documented, is granularity. In the US, obviously, given the size of the market, private credit CLOs have anywhere between 150 to 200 names, so the granularity is not really an issue there. For Europe, what we've struggled with in the past is to get a portfolio which is granular enough, because that is the fundamental driver in what your CLO structure is going to look like. So what was key for us is to obviously have the right kind of assets, which these guys obviously had on their balance sheets, and again, the right kind of size as well, which was key to kind of putting this transaction together. So there was a lot of iteration back and forth on that to kind of come up with an optimal portfolio that made sense for the equity in the CLO, and also that was viable with the rating agency methodologies as well. The next step was to basically, I work in BSL CLOs where every asset is rated, tradable, so it's easy for us to take a view on this. But for us to create a structure for something where we have an asset pool, we have no visibility on the underlying credit, how it's going to look like, we had to obviously lean in on the Barings team on that to see where do they underwrite them. And obviously, once we did the exercise, where they thought the rating should come out, the result was very similar. So that was obviously a good validation of the process they ran internally. So then the question was, why do we go with a static deal now, or do we go with a reinvesting deal? So I think, given this was the first time the product came to Europe, our view was that it would be probably better for investors to get used to the product initially, and basically they could underwrite all the assets on day one, because in a reinvesting deal, you obviously can have a portfolio on day one, but it can change, and you can have a completely different portfolio in 6 months' time. So the view was to have a static portfolio out there. Investors can underwrite it, get to know all the names, and that was a good selling point in the end as well.
Okay, interesting. Ollie, so the deal was static. If there is going to be a sequel, are we going to kind of see the same plot, or is there a plot twist, 4-year reinvestment period coming down the line, or what are your thoughts on the next iteration or the next private credit CLO that we might see? And Aleem, feel free to pitch in on that one as well.
Yeah, look, I think as Aleem mentioned, the first idea of the first CLO was broadly speaking, to keep it simple as you can from a structured CLO vehicle, and that was going down the static route. There are other benefits to static leverage and pricing and things like that, which can also benefit the structure. Ultimately, whilst we don't follow exactly the US market all the time, I think the market opportunity in Europe is not dissimilar to that in the US, and the US issue reinvesting vehicles quite regularly. So I do think that the next iteration, or at least at some point the next iterations, will look at reinvesting transactions. But I do think the importance of the first deal, getting to know, I guess, the asset base, the market, the manager as well, in terms of understanding their underwriting approach and getting comfortable that will be continued when you reinvest into names that haven't been identified. So I think that is important. But ultimately, these vehicles work better, the returns are better for equity, and ultimately, these are it's a cash flow arb vehicle. This was done for a cash flow arb, therefore it was done to make a return to the equity investors at the bottom. And to do that, reinvesting and be able to reinvest the vehicle over a period of time, generate alpha, is a huge part of that. And so I think reinvesting vehicles will mean you can get better equity returns, which will bring equity investors into the asset base and into the investor base. That will open up more liquidity. That will bring in new investors and will generally grow the market. So I wholeheartedly think that the reinvestments will come. Hopefully, we plan to be an active issuer in this space, and we will be looking at to do a reinvestment. Probably something along a 2-year non-call, 4-year reinvest is the expectation.
Yeah, I mean that is the obvious the next step here. I think the first hurdle was, what does it look like? So I think we have a blueprint for that now. We have a toolkit in terms of how you can structure these, how do they look like, and I think now that hurdle is over. The next phase of deals will have a reinvesting element. We are currently working with a few partners with the ambition of doing reinvesting deals. And again, for all the reasons Ollie highlighted, I think that makes sense from a commercial angle as well. And also, I mean, there's a lot of demand for this paper. When we obviously did this transaction, the approach was obviously to have more like a club deal with certain partners who were important for both Barings and ourselves. But the demand we've seen on the back of that has been phenomenal from all across, Asia, US, Europe, kind of people interested in the next wave of this product. Again, this is a significant market in the US, and there's a big overlap between people who buy that product there, and they want to obviously start doing that in Europe as well. So I think that definitely will be the next step.
Okay, well, Matthias, it sounds like you're going to be busy. Can you tell us, what does the ratings workstream look like with a reinvesting deal as opposed to a static deal?
Yeah, we're pretty busy with the BSL CLOs at the moment as well. No, I think reinvestment in the direct lending middle market space isn't reinvesting in BSL, right? This is basically replenishment. So a loan comes out of the portfolio, some new loans need to be originated and go into the portfolio, right? So I don't think it's as active as you see the trading activity in BSL. I also understand, we haven't seen a European one, but as I understand it from the US, that the deals go static at the end of the reinvestment period completely. That seems to be market standard, so not reinvesting unscheduled or credit impaired sales, and this is what you have in the BSL world, so that narrows it down somewhat as well. Thirdly, I would say with static deals, we always expect a little bit of cushion, because if that is structured to the line, this is the same with BSL and middle market, then obviously any deterioration in the portfolio could possibly deteriorate your ratings, right? So so when you look at our report that we did on the first one, there was already some cushion involved, and then so you could argue, well, if that cushion is left in the static deal, it's the same with the reinvesting deal, where you maybe have a little bit of cushion because of the covenants to give the manager a bit of flexibility over time. So that cushion is in there. So it probably doesn't make that much of a difference, to be honest, when it's a reinvesting deal with a 4-year reinvestment period compared to a static one, no?
Okay, and Ben, before I bring you in, just maybe one final question to you, Aleem. Do you think we're going to see a multi-currency private credit CLO? That was one of the hurdles that has kind of been discussed in the past around currency. What are your thoughts on that?
I think we probably will, yes. I'm going to go short on that. So currently, for example, for private credit, when you have bank financings, you do have the ability to draw in multiple currencies. In a CLO, obviously, most CLOs tend to be single currency. In the BSL land, and obviously the deal we did with these guys was also single currency. But I think in terms of getting the right granularity for the portfolio, I think there probably needs to be a mix of euro, sterling kind of assets. And again, that's what we're seeing. I mean, the partners we're working with at the moment, they obviously run multi-currency strategies across their platform. And I think kind of we keep pointing them to the fact that the CLO needs to be granular and there needs to be 60, 70 borrowers, for example, in the portfolio. So I think at some point you probably will need to look into aligning it with dual currencies to start with. And also, given that these new batch of deals will be reinvesting in nature, replenishing in nature, then I think you obviously need more flexibility to replenish those assets. So I think multi-currency probably will be a factor. It makes the CLO a little bit complicated in terms of, I mean, BSLs obviously are all single currency vanilla instruments, and there have been a few multi-currency BSLs in the past, but I wouldn't call them the market. So it does add a bit of technicality to it, but again, both kind of the raters we're working with on our next deals are kind of, you know, they're well equipped to size for that risk and address that risk appropriately.
Okay, Ben, thanks for bearing with us. And you might just give us some insight into the US private credit CLO market. Like, I understand that, you know, private credit CLOs have grown in the US to represent almost 20% of total CLO issuance in the US CLO market. So what's driving the popularity in that product? Like, is it a credible alternative financing method in the US? And you might just kind of give us, you know, your thoughts on that.
Yeah, happy to. And you know, I think Ali hit on a lot of the thesis in his initial remarks, but you know, from my seat, it starts with understanding the fund that you're trying to finance. You know, what's the leverage profile? Who are the investors? What's the ultimate return target? What's the risk-adjusted return they're trying to achieve? And then for levered funds, how do you go about that? What's going to be the most optimal form of financing that you're going to incorporate into that fund to really achieve that goal? In the U.S., we do have a multitude of options, you know, in the fund finance spectrum, you know, depending on the product. But subscription lines, hybrids, ABLs, CLOs, those are all part of the toolkit, if you will, you know, in order to, you know, really achieve, you know, the objectives for the investor. And so that's what I think, you know, what we're talking about here today. That's the corollary between the U.S. and Europe, where you know, someone in Ali's seat, you know, will be looking for the most optionality to finance the assets in his portfolio. And so then, you know, it really becomes a question of the specifics of those assets that you're trying to finance. I do think there is significant upfront cost, you know, when you think about a CLO. 2024, for example, in domestic U.S. private credit, we had 8 new managers. Some of these were broadly syndicated managers that, you know, also dabble in the upper middle market. Some of these are legacy private credit managers that just never utilize CLOs, but because of the duration, they're typically 4 to 5 year reinvestment periods. The leverage is typically better than what you would get in a bank facility. There's no kind of bank valuation rights. It's all rating agency driven in terms of, you know, cash flow haircuts. And the pricing, you know, in an established market should be more attractive than what you get in the bank market. So all of those factors, you know, when a market fully develops, will allow for managers or incentivize managers to go through the process. But getting the first one done is the most difficult because it's going to need to have some predictability component. You know, you're not going to go through the credit estimate process on 40 credits if you think they're going to get, you know, less than a single B rating. It just would defeat the purpose. Further, as you're going into the life of these deals, you need to have some type of idea how the rating agencies are going to react in periods of stress, i.e., will there be mass downgrades? How do they handle, you know, certain, you know, credit red flags, if you will, in the quarterly financials that they get in their review? Even for some portfolios that have certain, you know, specialties. Software is a good example of that. Will the rating agency give end-user diversification as a form of diversity credit instead of just lumping everything into one kind of software category? So all of these things, I think, take time to kind of develop. It's different for each manager, but from someone in my seat, we have 10 CLOs under management. The majority of those CLOs are used to optimally finance assets in our funds, lower levered, BDCs, 2 times commingled funds, and then as the market has developed, we've been able to raise capital that's looking for a higher leverage profile. But I still think the majority of these deals are used as kind of fund finance alternatives.
Okay, and maybe just to tag on to that, and I'll open this up to everyone here, I guess, do we think that the US boom will translate to the European market in private credit CLOs? And it hasn't to date, so what's causing the delay? So
I mean, I'll jump in. Look, I ultimately think yes is the answer. I think really, when you look at how the US market has grown, it was 10 years ago, it was 6% of CLO issuance was mid-market. It's now 20, 30%, depending on the year. I think that really shows you the opportunity set in Europe, but it also, I guess, begs the question, if 10 years ago it was 6%, it's only the first one was done last year. But I think that comes a little bit around, the growth of the private finance mid-market here in Europe, and it's sort of exponential growth over the last few years. So, a little bit behind there. It's traditionally been a banked market, so the emergence of private finance and the growth there has allowed, I think, the opportunity set now to come about. And as investors get comfortable in the US and the US mid-market, they're starting to look across into Europe and looking for the same yield pickup that potentially that the mid-market transactions provide them. And I think as investors across the globe have got comfortable or looking to allocate into the private finance space, you've got certain investor types, the insurance companies, the pension companies, who like certain parts of the capital structure, right? Double A's, single A's, really work from them on a maturity and duration and spread per rating perspective. And suddenly this is giving them access to the mid-market or private finance, whatever you want to call it, market exposure through a structure where they can get the ratings and get the sort of the spread that they need. So I think that makes it a super attractive proposition for the market. And I really do think that ultimately that's going to end up in growth. And if you look at, as I said, the US market being 20% of the overall market, I think it'll take us some time to get there. But if it's not 5 to 10% in the next 10 to 15 years, I'd be very surprised.
Yeah, I think that's a great overview. And the growth that we've seen have been driven over the last 2 to 3 years by crossover investors. If you look at the broadly syndicated market in the United States, it's an amortizing market. There just isn't enough new issue loan flow to satiate over 100 distinct managers all trying to do 4 to 5 deals a year. So what you're seeing is consolidation. What you're seeing is just overall amortization as deals are coming out of their reinvestment period. And with that growth, though, there have been a number of asset managers, banks, insurance companies that have added CLOs as part of their allocation. So the result of that is many of those investors doing a lot of work on private credit managers, starting at single A, migrating down to double A, and getting comfortable there. What have been the roadblocks? It's transparency on the assets. As we've talked about, these are not publicly rated assets. Many of these are to companies with 25 to 75 million of EBITDA, in the markets that we're looking at. So these are, again, small companies that aren't really transparent. So how do investors work with the manager to get comfortable with the information on the assets? And then the second is going to be liquidity. I would say at this point for tier 1 private credit managers in the United States, the liquidity on their AAA is going to be just as good as many of the broadly syndicated managers. And so it takes time for that to develop, but as you've seen, the amount of capital that has flown in has not only allowed for growth, we've talked about 20 to 30%, but also the basis between a broadly syndicated AAA and a middle market AAA has gone from a historic 50 down to 20 to 25 basis points. And all of that is because investors are looking for good risk-adjusted return. In my opinion, there's once you kind of crack the code on a lot of the, asset characteristics that make the ratings work, there's nothing that would stop that growth in Europe in the private credit space.
It's probably worth noting, and Liam touched on it a little bit, the interest and actually even the first transaction, this wasn't sort of your traditional European BSL CLO investors. It wasn't sort of moving those across to the market. It was actually sort of people who maybe necessarily haven't been in the CLO market buying liabilities before. That's where the interest has come from a lot of places, which really screams to the fact that there is a huge amount of interest, demand for this product outside of who's already doing it in the BSL market. And I think that really supports the belief that with the right product and enough of the right product to create the vehicles, and as Ben says, getting over some of those hurdles around diversity and information flow. But I think as you get more managers in the market, you'll be able to really understand investment processes, you'll be able to really understand the underlying assets better, there'll be more knowledge. And in fact, some of the guys that are looking at this product already kind of know that a little bit because they're already involved in it somewhere around in the space. They've already got an allocation, and this kind of works for them in maybe another pocket of their asset allocation exposure. So I think that's a really supportive thing for the market.
Shall I take a little bit of the contrarian view here? No? I agree that there's certainly interest on the investor side. No, I mean after the first deal. The number of investor calls we got, and they want to talk about the deal. 150 basis points, 45 is obviously attractive, and the BSL market.
147.
I'm sorry. Is at 120. But I think it's the availability of assets. Really talking only the larger managers, and even the larger managers. You included BSL names, right? To get the granularity in the portfolio. I think when you do a CLO, you're going up, at least sort of from the rating agency side, we look at it, okay, we're rating AAA, AA, so they're very high ratings, as opposed to fund finance, where we're generally talking single A. So perhaps at the single A level, there's a little bit less stress being applied to concentrated portfolios. So this middle market lends itself to that. But if you go to AA, AAA, we sort of max out in the stress portfolio modeling the flexibility the manager has, right? And concentration plays into that. I think in terms of concentration, when we look at the portfolio, the top bit, which is over 50 million EBITDA, is in competition with the BSL market. So the BSL market was last year quite competitive. We saw a lot of refinancing, and that probably puts pressure on the sort of origination volumes there from that end. At the lower end, you have a very strong bank market in Europe, right? So you're effectively competing with them for conditions. So I think even the larger managers in Europe probably struggle to put together a granular portfolio. And on top of that, you have the currency issue that we heard before, right? The European market is split, GBP and Euro. And so you need to overcome that. Having said that, we'll probably see a few more. I don't think it's an avalanche.
No, I think that's fair to say. Asset sourcing is a problem for BSLs as well as, we're all talking about M&A. I saw the end of the last conversation, and they were talking about M&A activities, and wholeheartedly that's a big driver of sourcing assets, creation of assets, and we need that in BSL, we need that in the mid-market side of things. So I think that's right. I think you're right in the sense that it's not suddenly going to be a big market overnight. You're probably going to find that, as ourselves, one a year is probably the fastest cadence you're likely to get out of it to begin with, and it probably means you start specifically warehousing to do the CLO because you need to get the assets in over a year or 2 year process. So that does take time, and obviously you're going to have a manager that also has a reasonable grounding within the European CLO market. There's a lot of pipe work that goes into managing the CLOs, the complex cash flow products where cash flow has to be directed in the right way under the right circumstances. So you need need to have the the infrastructure internally to do that. The legal expertise to understand the legal documentations and the pitfalls and what you can within those. So there are barriers in that sense. So it's not going to be something where anyone who wants to come and do it can do it day one. But we've seen in the BSL side of things, new emergence of new managers coming into the space. Asset sourcing is challenging there, I think, as well. But there's a will and there's a demand. These markets will find a route to doing that. And as you say, it's not going to be suddenly a 50 billion business in the next 10 years. But I think you're going to start to see incremental growth. And if it's 2-3 deals this year, 5 next, I think that's probably the most likely cadence rather than 10-15 deals per year. But I think it should get there. But I do appreciate that we need to get assets and get M&A going, and I think that's a general quibble across both markets.
Yeah, I mean, just to add to that as well, I think in terms of, I think warehousing probably will be the next element as well, because to kind of get the asset sourcing, you probably will need to have warehouses that are tied to the CLO, so the manager has time to ramp. And in BSL, warehouse can go anywhere between 12 to 18 months, and you have time to ramp. So I think that will be the next step as well in terms of getting a warehouse in place so the manager can ramp. But I think, we obviously spoke about the challenges, but taking a step back, the proposition is quite attractive, right? If you look at the transaction we've done, you're talking about 85-90 LTV at 240 cost of funding, and this is locked in for 6 to 7 years. Now again, you compare that to the bank market. So again, it's nowhere near big enough right now to compete with the bank market. So I think both have to coexist, like we see in the US. But again, for a bank market, you have the terms obviously going to be 4 to 5 years. There's always going to be a mismatch between your assets and liabilities in the bank funding market. You overcome that in the CLO by locking your funding for 13, 14 years. You've obviously got a much more credit reactive approach in the bank market. You obviously got reval events, which you don't get in the CLO. And obviously, if you have rating downgrades in the CLO or even defaults or restructurings, you just delever your notes, right? That's what happens. So I think those propositions are quite interesting, and now we've got kind of a toolkit to do it. So I think the opportunity set here is quite interesting.
So optimistic. Yeah. Okay. So we might just move on. Aleem, you might just give us a sense of kind of relative value, kind of middle market CLO versus BSL.
Yeah, sure. I think again, Ben touched upon that. So I think it's when we did the initial transaction, I think where it priced, it was in the tiering between BSL and mid-market was pretty much in line with what we see in the US. At the moment, it's at an all-time, kind of you mentioned, it's 20 to 25 basis points, right? So the gap is obviously tightening. In the European space, we are, again, seeing a lot of interest from anchor AAA accounts who play both sides of the pond, who are very familiar with the US mid-market product, and now they want to get involved in the European product. So I think it will be a competitive pricing landscape in Europe for the next bunch of deals that come through. There likely will be a premium on the mid-market compared to where the BSL is printing, and in all likelihood, your terms will also be stricter. Like we mentioned earlier, that in a BSL, you have flexibility to reinvest even after your reinvestment period has finished, which obviously leads to extension risk for the note holders. But in a mid-market deal, you wouldn't have that functionality. So as soon as your reinvestment period has finished, then you basically start to delever the transaction. So that's an attractive proposition for any investor, and they probably can pay up for it. So again, I think there will be kind of competitive price tension, but still you would expect to get a decent premium on what you get in BSL for a mid-market. And the last point to add is that you will also be expecting to get more credit protection as an investor. So we talk about power subordination, credit enhancement concept in BSL CLOs. We expect mid-market CLOs to have a higher subordination, just to account for the fact that they are not as granular as BSL CLOs, and also the fact that they have other kind of unique characteristics by way of kind of pickability and other features that we don't see in BSLs.
Okay, brilliant. And I think the maybe penultimate question then, I think, Ben, you've touched on it slightly already, but why are people now looking to the CLO market as a form of financing? And I don't know if you want to, take a stab at that. And
yeah, I mean, I think, we're, for, folks who, manage capital, we're fiduciaries, and it's incumbent upon us to find, the best ways, the newest technologies, to deliver risk-adjusted return to our investors. And so, I think we've touched on, certainly a lot of the structural merits of why the CLO makes sense, from leverage to pricing, to more cash flow methodology as opposed to bank revaluations. All of those things, present a really attractive case, but, it's also comparing it to how are you going to use the CLO. And so, when you're looking at a levered fund, in Europe, I think it's fair to say has a less levered appetite than dollars in the United States. How is that CLO going to look? What kind of fund is that going to, work really well in? And so that I think is going to be the exercise. It's going to be, how do you take a CLO where you've seen proof in concept, on both broadly syndicated and private credit in the U.S. and broadly syndicated in Europe, and how do you, kind of apply that, to private credit in Europe? But I think, Ali hit the nail on the head. Where there's a will, there's a way. It will probably take some time, but I do think that it is going to become another, really good option in the toolkit, if you will, to, provide debt capitalization to your fund.
I think that's right. I mean, it really comes down to, I guess, two things from the manager: diversity of funding. We manage SMAs, commingled funds. We manage for our parents' balance sheet, BDC, et cetera, which allows us to be constantly in the market and not tied to a fundraising or a fund at any given time. And I think that's how we want to approach the market, in terms of always being there and talking about, should we do an investment, not can we do an investment. And obviously having the CLOs as another alternative route to financing suddenly opens up more optionality, and obviously gives you more access there. Second thing is, these funds are, as Aleem alluded to, they're locked up capital that pays an ongoing fee to the manager. Certainly in BSL space, where funds are commingled funds can go in and out, locking in capital, locking in a fee income stream is obviously a great place to be for a fund manager. It gives them consistency of income and what have you. So there are lots of reasons, but I think diversity of funding is a huge part of it for us when we look at this as an optionality.
Great. Okay. So the deal closed on the 16th of December 2024, so not quite a Christmas miracle, but a watershed moment for the CLO market. We've kind of touched on it, but do we think this, the kind of private credit CLOs in Europe now can kind of, supercharge private credit lending activity in Europe? Is it going to lead to more private credit activity and lending space?
I mean, you probably should ask some of the people in this room rather than me, seeing as more focused on BSL. But I think it comes down, yes, it's going to improve optionality, liquidity. It's going to come down to origination of assets in terms of how supercharged the sort of private finance is. There's obviously been a groundswell in the product and the asset class, and an allocation towards that. Obviously, is likely to continue, and this will add to that. I think that's always going to be the controlling factor is the ability to get assets for the asset class. I think it'll be supportive of the growth that we've seen in this asset class over the last 10 years, and it's been pretty seismic already, so it probably continues.
Great. Unless anyone has anything else to add, I think we've 1 minute left. So if anyone has a question for any of our panelists, speak now. No, I'll take that as a no. So all that's left for me to do is to thank our panelists for a very insightful panel, and thank you for joining us.
Thank you very much to Paddy and the entire panel. We are now in a refreshment break until 4:30, when the session in this room will be the spotlight on sponsor-led versus sponsor-less deals, and the final session, what does the future hold for European private credit?